Good morning and welcome to GrainTV. My name's Cody Bells. This is Logan Burgess. Today is August 8th and the markets are trading down a bit this morning. Corn trading down 5. We have soybeans trading down 2 1/4. Wheat in Chicago trading down 14 1/2, and Kansas City wheat trading down 15 1/2.
Yeah, Cody, looks like the grains in general here kind of pulling back this morning. What's pressuring this wheat market, leader of the downside here in the early going?
Well, we had a news announcement out of Russia, and really the Deputy Prime Minister over there said that there's no measures needed to regulate exports right now, and there's an exportable surplus of about 10 to 12 million metric tons of grain. So really, until that exportable surplus is not nearly the amount that it is, really there's no need for any sort of tariffs or export bans.
Certainly. Well, it seems like a little bit of a premium has been built into this market as people are concerned that we might see a situation similar to 2010 here this year. Kind of pressuring corn and soybeans here to the downside in the early going this morning is just some precipitation outlooks here. As you can see, this is today into tomorrow and into Saturday. We're expecting some good chance of precipitation across much of the Corn Belt, but I think the really important thing at this point is the temperature outlook. As you can see right now, we're expecting highs between 94 and the high 80s for much of the Corn Belt. You can see here as we move into the weekend, temperatures should back off dramatically here. Low 80s to even the high 70s for much of the Corn Belt. I think the soybean crop in particular will benefit from this. A lot of people view the corn crop as too far gone, but this is going to certainly pressure the soybean complex here a little bit as we're in pod filling stage.
One thing that I think people should note about this weather event is that we aren't seeing soybeans and corn sell off significantly this morning on that news, and I think really the market is so seriously anticipating this this next WASDE report that I think it's very difficult. We're going to have to see a real significant weather event. Though this is significant and it should help soybeans, I think it may be difficult for it to sell off in the face of this report.
Right, certainly. Maybe a sideways trade here on Friday. We'll keep you posted on GrainTV. We're going to take a quick commercial break here. We're going to be back and kind of look at a strategy that a lot of producers are using right now to put hedges in on the new crop corn and soybeans.
Grain hedge is more than just futures trading. Clients receive our cash grain optimizer showing spot and forward bids within 200 miles of your farm. We take into account your trucking costs to find your best selling opportunity. We provide in-depth basis mapping, historical basis and cash price charting. Every day we show you your best price and if it meets your profit goals. Contact GrainHedge today to get started.
Welcome back to GrainTV. One of the things that we really wanted to go over here is how a producer can actually put in some types of orders that protect themselves when they're not always sitting at a computer. Today we're going to talk about the one triggers one order. Logan, can you kind of take us through it?
Yeah, Cody. Well, right now a lot of our clients have been using this effectively as they sell into this market here. And basically what we're going to do is we're going to sell at market and we're going to put in a buy stop above the market so that we get out in case this thing pushes higher. So let's kind of walk through how you would do that right now on Fire Tip. Right now we're in the trading matrix. We'll be dealing in D's corn, so we'll select that contract. We'll go up here and hit place order. As you can see now, we get the order entry window, and this is a pretty straightforward window. It comes up by default right here as the order type is a single order, and what we're going to be doing, as Cody said here earlier, is a one triggers one order. You can see now this order is going to have two legs, and when the first one gets executed, the other one's going to automatically be in the market. So as we said here, we're going to be selling one December 12 corn. It's already selected for us. We're going to be selling this at market, and this is going to be good for the day here. Now the second leg of this is that buy stop we were talking about. That's going to be in there above the market. That's going to protect us if the market starts moving higher. We'll switch the side to buy. We'll select a quantity of 1. Once again, December 12 corn is selected for us. And here in the type of order, this time we're going to be using a stop order. Now on a stop order, you can specify the price level. You can see here a market order has no specific price. It gets executed at market. A stop is going to be executed at a specific price. So let's give ourselves about a 10-cent buffer here above the market by clicking the plus sign there. And this is going to be good till cancel. It's going to be resting in there until we decide to actually cancel this order or it gets filled. So once we have everything in here, what we're going to do is go ahead and hit submit order. We just got a fill confirmation here. We sold one, And we can see now in our working orders here, we have a market order that was filled to sell, and we now have a working order, that stop order that we spoke about before here, working above the market in case, let's say on Friday's report, yields come in really low, this thing starts moving higher. That stop will be in line there to hopefully get hit.
Yeah, the advantage of a stop really is if the market doesn't do what you're expecting. You may limit yourself in terms of margin calls. So if this market breaks higher based on news that fundamentally changed the game here, you can just take a 10-cent loss on that hedge, kind of lift it, get out of the market, let the thing run, and then reevaluate where you want to start pricing again. So it just kind of helps you protect that if you're hoping to minimize any margin calls.
Right.
If you're really doing a true hedge, you want to get this position on, sell one contract. You may not want to have a stop order,
right.
But it is nice when you're trying to limit potential margin.
Right, certainly, especially at a time right now where the market's consolidating, and Friday is going to really give this market direction. I mean, a true hedger, could sell it there and let it move lower, but this has been a very effective strategy that we've seen quite a few guys using here. So we wanted to share it with you here this morning on GrainTV. I think that kind of wraps up our show here for Wednesday morning, Cody. Thanks a lot for joining us. Have a great day.